Economist here. So the big news: the Federal Reserve cut interest rates, and by pretty significant too, a half a percentage point, which was at the higher end of what a lot of predictions were out there. Many people were thinking it was going to be a quarter point cut. Many people were thinking it was going to be a half a point cut. But the markets were very unclear about what it was that was going to take place, except that there was going to be some sort of cut. Now, what I find very interesting about it is that as I'm reading through, I haven't listened to the press conference because it's kind of happening right now for those who are watching this video as it after it uploads. So the press conference has taken place, and we'll get a little bit more information off of his speech that he delivers to the media. But just kind of going into some of the articles that are coming out right now, this is quoted out of CNBC. The committee has gained greater confidence that the inflation is moving sustainably towards 2% and judges that the risks to achieving its employment and inflation goals are roughly in balance. So they are seeing the economy is in a direction is that they are finding approving for the conditions that they are in, but they are cutting interest rates, which I think is going to have a profound impact on the market's perception of what's coming to the future. There's many people out there who are saying such an aggressive rate cut will then signal to the markets that bad times are coming and that they will start behaving accordingly for a recessionary pressure or something of that nature comes. Now, typically, if you go and you look at the Fed funds rate, like type in Fed funds FRED or something like that, and go look at a chart of the Fed funds rate, and anytime you ever see the Fed funds rate coming down, it almost always leads into a recession. Like the Federal Reserve will drop interest rates predicting recessionary pressures coming and then falls into the recession. So a lot of times people will look at the Fed funds rate adjustment as far as going down as a recessionary indicator, or not necessarily the indicator, but the indication that the Federal Reserve is attempting to prevent or dealing with the fact that a recession is coming. Does all that kind of make sense? So this is going to be pretty much what the mainstream media is going to be talking about, and how employment or layoff is rising, like layoffs are going up, unemployment is rising. The Federal Reserve has the dual mandate. However, unemployment is still pretty low considering if you look over like the historical averages of it, it's really not that high. So now, something comes to mind when I think about the Federal Reserve and the adjustment of interest rates and what that is in reflection of the neutral interest rate that is out there. Something that is not talked about a whole lot through the mainstream media, the economist out there, or even the Federal Reserve doesn't really bring up the fact that the neutral interest rate is a very big concern for the Federal Reserve. Now, I did leave a link down in the description to the New York Fed. I'm not sure what it is, measuring the neutral rate of interest. So the Federal Reserve does actually have a way of guessing where the neutral interest rate is, because the neutral interest rate is not something you can observe in real time. It's something that you can observe in past. Like if you look in the past, you can see where the neutral interest rate is. But as far as the current neutral interest rate, this is very difficult to try and see in what it is currently, like in this exact moment. The Federal Reserve offers up something called R star. Now, R star is their best guess at where neutral rate is. And if you go and read like how it is that they develop this method of figuring out R star, it is incredibly complicated and it doesn't make a whole lot of sense. So you really just kind of have to leave it up to like trusting the Fed and their mathematical formula for figuring out what R star is. But since nobody knows what the neutral rate is, R star is our best guess at what that would be. Now, something that I found very interesting about R star is that if you go and you look at the chart of it, it is really low comparatively to what we had experienced back in, say, all the way up to about 2000, even into 2005, just before the great financial crisis. The neutral interest rate was significantly higher than what it is today, like a lot higher. And very much in the concern of the Federal Reserve is that the neutral rate was very close to zero, which actually was taking place basically since the great financial crisis, leading all the way up until about 2014, I'm guessing. And then you see the neutral interest rate begin to rise, but it doesn't rise significantly. It just moves up just a little bit. And again, there's a couple of different ways of judging where the R star or neutral interest rate was going to be. But just consider that it didn't move a lot. So it had fallen very close to zero. When it did move up, it didn't move up significantly, but did have some increase. Now, we saw a the most significant increase to the neutral interest rate towards the beginning of the pandemic, when the inflationary pressure was the highest, when most elevated inflation expectation was occurring within the economy, was taking place back towards the beginning of the COVID pandemic, right? Back in 2000. So if you look at the R-star chart, you're going to see it peaked out in 2000, right? And it was staying somewhat elevated, not exactly like elevated in the sense that it was back to what it was back in the 90s, but elevated to the sense that it didn't drop all the way back down to zero. However, it is falling. The neutral interest rate is going down. And this is important to understand because the neutral interest rate, in accordance to the Fed funds rate, is the restriction to the economy. So as a lot of people are thinking, okay, the Fed is cutting rates, this is going to make monetary policy easier. It doesn't. It's less restrictive. Okay? It's a less restrictive policy. It's not an easing policy. Like an easing policy means that you would be below the neutral rate. That would be accommodating. That would be easy money policy. What we have is restricting monetary policy, just less restrictive when they cut the rates as much as they have. However, watching the neutral interest rate fall means that even if they were cutting rates, they are chasing the neutral interest rate down, which doesn't add much of a stimulating effect or even a less restrictive effect coming to the economy. And this is the reason, what I feel, the reason that the Federal Reserve is truly acting in the, or not acting, achieving the adjustments of the interest rates. And that would be the real reason why, is to make the economy no more restrictive. Like if they were to stand still and the neutral interest rate kept falling, that would be very restrictive to the economy. In fact, people would look at that and say the Fed is standing still, but really that would have an increase in the restriction if the neutral interest rate fell and the Fed didn't follow it. So ultimately, the Fed is standing still in the neutral position as far as the spread between the neutral rate and the Fed funds rate. So it's not going to be an easy money, any easier of a policy going into the future if the neutral interest rate continues to fall. Does that kind of all make sense? This is important to understand because nobody's going to talk about the neutral rate. Nobody, I mean, you might find some people out there, but nobody's going to observe it. Nobody's going to internalize that information and then look at it in the sense of, is this going to be easier or less restrictive policy? Not understanding that the neutral interest rate is falling at the same time. Right? So again, this is important to understand. I left a link to that down in the description for you guys. And so when we think about how it is that the markets are going to react to this, I do have to think back to that. It was like, okay, are the markets going to be approving of this idea? I mean, a 0.5 point rate cut is huge. That is a huge interest rate cut. That is like saying that we have issues. That's essentially what they are saying, is that we have issues. And now people are going to look at unemployment, they're going to look at the layoffs, they're going to look at the bankruptcies, they're going to look at all this stuff. But the one thing that they are not going to mention is the neutral rate. So watch that, watch it continue to fall. And then think about whether or not that's going to be restrictive or accommodating if the neutral interest rate falls at the same pace that they're cutting rates. Again, this is important to internalize and think about. You know, I know a lot of people were saying that, like, we're anticipating the rate cuts and how that's going to be, like, impactful to the economy as far as, like, how that's going to impact mortgages, how that's going to impact our credit cards, all that other stuff. And it's going to be very impactful in the sense that the interest rate adjustments do eventually lead into actual interest rate adjustments into the markets of like credit cards and car loans and all that other stuff, but that takes time. There's a lag period that takes place within it. However, if you go in again and look, you can already see that the mortgage rates are coming down. And they've actually come down quite significantly over the last, 6 months or so. And if you think about the credible threat theory within that, it makes a lot of sense that people start behaving in a way as if those rate cuts had already occurred. So you already see that occurring within the economy, right? I mean, this is the forward guidance shortens up, could possibly shorten up the lag period. And again, that's important to look at, because when people say, man, the mortgage rates are already coming down ahead of the Federal Reserve is acting in accordance to that, they're not. It's the market's perception of what was coming. You think about it, like people were believing that there was going to be 7 rate cuts coming this year at the end of last year. Like at the end of 2023, there was the dot plot that came out and had this 7 rate cut prediction coming to the economy. People started acting accordingly. You go and just take a look at the mortgage rate. In fact, let me bring it up here real quick. If you just type in, let's see here, mortgage rates, FRED. Right. And you could bring up the fixed 30-year fixed rate for mortgages. And let me see. Let me bring it back to a year. All right. So those rates had peaked out in October of 2023. Now, shortly after that, you saw the Federal Reserve bring out the dot plot map and all this other stuff, and a huge drop in the mortgage rates took place. I mean, within 3 months, it went from 7.7 down to 6.6. So it was over a whole percentage point within just a matter of a few months. And now, again, everybody believed within the dot plot that there was going to be this huge, interest rate cuts coming throughout all of 2024. But then they realized, man, that is not going to be taking place. And by May of 2024, interest rates had climbed, the mortgage rates had climbed back up to over 7%. They were at 7.22 in May. And then again, right, forward guidance, the job owning, the signaling, whatever was coming out as far as rate cuts and peaking out of Fed funds rates and all that other stuff, like they're no longer raising rates kind of information started coming out. And again, you started seeing the mortgage rates fall, and they're falling all the way to today, which they are at 6.2. So all the way within a year, they went from 7.79 all the way down to 6.2, and the Federal Reserve had done nothing with their Fed funds rate during that time. They completely sat on their hands and let the markets do the work for them. They have a whole interest rate point dropped out of the mortgage markets. Now, whether the Fed, but that's what came out, more than that, almost a 1.5 percentage point, 1.5% came out of the mortgage rates within less than a year. And again, that was all done off of market perception. Federal Reserve did nothing. I mean, they did do some balance sheet adjustments, but that took place probably right around that May, right? Shortly before that. I think it was in June, wasn't it, that they did the balance sheet adjustments. And so there was some difference to the monetary policy coming from the Federal Reserve within the balance sheet adjustments, but the Fed funds rate didn't move. But yet mortgage rates moved, interest rates moved all over the place, all based off of perception. And again, it's still perception that has taken place if you consider the neutral interest rate is falling at the same, leaving the spread between the neutral rate and the Fed funds rate essentially the same, as the Fed funds rate is chasing the neutral rate down. Give it some time. If we have inflationary pressures, if we have a change into the economy, if there's something that is now triggering the markets to believe that inflation is going to be running rampant again into the future, you might find the neutral interest rate rising again. And if the neutral interest rate rises at the same time that the Federal Reserve is lowering rates, you will find that the economy will be less restrictive. So literally inflationary expectations could possibly make the financial markets less restrictive by raising the neutral interest rate. Okay? This is important stuff to understand. And because again, nobody else is going to bring this up. All right. 74 people, 336 people watching. Now you're let's hear. Let's cruise it up here. We got Lumberjack Landlord up in the house. Great to see you here, man. It's about ultra wealthy. It's Main Street. I am ultra wealthy. I can weather any storm. It's about the mainstream economy. Yeah. Can you assume the neutral interest rate based on average loans interest rates over the last 2 to 3 years? I am not going to try to assume the neutral interest rate. Like, even trying to understand R star is very difficult. Like, you can look back and, find that the neutral interest rate, but by the time you look back at it, it's only like a confirmation of what you may be feeling or maybe misunderstood. But as far as current levels, the only thing that I can think of to try and have any kind of accuracy to the neutral rate is the direction in which that it is moving. And that, I believe, will move off of inflation expectation. So if inflation expectation falls, even if it's still elevated but falls, like if it falls down, like people were thinking, okay, we had 8% inflation, then 5% inflation, and 3% inflation. If that's the case, and I would imagine that would still, bring the neutral rate down. If people start looking at it saying, oh, this is going to go 3% to 4%, like they start seeing inflation increasing, I believe that would move the neutral interest rate higher. And that is because most people who understand that inflation is coming would then demand a higher return on their capital investments, which would then start bleeding into the rest of the economy and start pulling the neutral rate up. But if the inflation fight is like essentially won, if the markets believe that, then I think the neutral interest rate would continue to fall. It's, again, I believe it's all off of market perception. And it's funny to think that the neutral rate falling, which is pretty interesting to try and internalize and think about. But as the neutral interest rate is falling and the Fed staying still, that makes it restrictive into the economy. You look back and you think, okay, all the layoffs, the bankruptcies, all this other stuff that is happening out there, it would make a lot of sense. I mean, people will just automatically look at the Fed funds rate and think that being elevated would do it. But if you had an elevated Fed funds rate and the neutral interest rate was able to continue to rise off of maybe inflationary pressures or something, just hypothetically speaking, it would make the economy less restrictive. Eventually, if it continued on, neutral would find the Fed funds rate, and the Fed funds rate would be neutral at an elevated position. Like, that's how the neutral interest rate affects the economy. It takes time for it to get in there, but it's very important to try and pay attention to. And again, some of the reasons why the neutral interest rate was falling is now still prevalent. They're like the three main global trends that the Federal Reserve was describing for bringing down the neutral interest rate over the previous decade was due to a demographics issue, as the older population and birth rates had fallen. The global growth around the world had slowed down dramatically. And then there was a wider wedge between the safe and liquid assets like U.S. Treasuries and corporate debt. Now, something I find interesting when I think about those three issues. The demographics issue, I wasn't one that paid attention to the numbers coming from, the mainstream about the COVID deaths and all that other stuff. But I heard a fairly significant amount of the older population had passed away because of it now, or during that, I should say. So whether that was actually fixed the demographics issue, I'm not exactly sure if it fixed it. It's probably still a fairly major problem within the idea of the neutral interest rate falling, or the issues that were bringing the neutral interest rate down. I don't think that was necessarily cured. It might have stalled out the issue, but as far as reversing it, I don't think that happened. I still think that's still a major issue, older population and not enough, or a low birth rate. So that being one of the reasons why the neutral interest rate was coming down, I think is still fairly prevalent within the economy. The other one was a slowdown in global growth. Well, considering that we have like global recessionary pressures happening, I don't know if there's any increase in global growth really happening at this time either. And then the third one was that wider wedge between the safe and liquid assets of U.S. Treasuries and corporate debt. And now when you think about the U.S. Treasuries coming down, you're finding the yields are coming down in, across the board from their height, right? I mean, they were quite elevated as the Federal Reserve was going into their quantitative purchase or going into their quantitative tightening, and the idea that there wasn't going to be as many buyers in there. You saw elevated yields, but they are come down fairly significantly over the last few months, and sitting right now on the 10 years like somewhere around 3.6. That is elevated considering that at one point it was close to zero, but the wedge between that and the corporate debt is still fairly wide. So I don't see how the neutral interest rate, based on the ideas of what had driven it down before, have necessarily been cured at this point. There was a moment in which that they were, say, being dealt with. I mean, if that's the accurate way of describing it. But that has basically, been removed from the economy, and the issues are still prevalent, right? There's still issues with the neutral interest rate and what's driving it lower. All right, let's see if we got some comments in here. All right, let's see here. Asking the question of lumberjack landlord, do you see the stock market crash as well as precious metals dropping by the end of 2024? The reply, gold and silver up, job losses. Gold and silver up, job losses up, stock market correction with compression of the multiple and delinquencies on everything will go up into crash. It will correct. Will go up. It won't crash. It will correct. There we go. All right. Well, thank you guys. I mean, it's awesome you all talking up in here. They will do anything not to say recession. Yeah, and I still am very much of the belief that we could still be facing the recessionless recession. I mean, how many people were actually saying that there was going to be a recession in 2023 and then 2024, and now people are saying, oh, it's going to be in 2025. The Federal Reserve dropping Fed funds rate typically, I think there was very few cases in which that the Fed funds rate falling didn't lead to a recession. Let me see if I can bring it up, what year it might have been. So the effective fund rate, and it had fallen, let's see, the only time that I see where it really fell significantly and didn't lead into a recession was 1984, right? Every single time there was a little bit of a drop, say back in the mid 90s to about 98, there was a drop, but then it rose. The Fed funds rate rose well above that 95 high to only lead into the 2000, early 2000 recession, the dot-com bust. So again, like the only time I really ever see the Fed funds rate falling and didn't lead into a recession was 1984, right? Every other time it's done it. So it would be very like understandable to see the markets anticipating recession coming. That would be very, very typical of the Fed funds rate falling, and then what the markets would be seeing or looking back in history to gain some idea of what's going to be taking place in the future. When the Fed drops rates, recessionary pressures start to enact. Now, I have to think back to my ideas about a recessionless recession, because still, when the Fed is dropping rates, they're usually trying to deal with the fact that unemployment is rising. And that's part of their dual mandate, is that they're trying to make sure that unemployment stays low. Right? This is like, the Fed has a dual mandate, low inflation with stable prices and full employment. Now, back in the day, they used to look at employment a little differently than they do now. See, before the great financial crisis, the Federal Reserve would look at employment as the inflationary pressure indicator. If there was very low unemployment, a lot of people were working, that added amount of labor then got paid, that getting paid then added to consumption. So as more people were working, it was adding to consumption. When you have supply demand imbalances due to the added consumption, prices move up. So the Federal Reserve used to keep a very, very, very close eye on the unemployment level and where it was in accordance to what they even had as a neutral unemployment. There is such a thing as neutral unemployment level. Let me bring that up because that is also significantly low. Let me see if I can find out where that is. And so that was very, that would be like, it was significantly low over the last few years, but the Federal Reserve would typically look at that and say, okay, if we figure out a way to lower rates, that would start sparking business investment. They would start hiring people. That hiring of people would then add to the consumption and then start creating the inflationary pressure that they were looking for. And then quite on the opposite of that, if they had inflation running high and they wanted to slow inflation down, then again, they would raise the interest rates in an attempt to kind of stop or prevent as much business investment. And when you have slowdown in business investment, generally you have a slowdown in hiring. Less people working, less people consuming, and then less inflationary pressure taking place. Well, they found that after the great financial crisis and the running into zero, the employment rate could run as hot as it wanted to, but not create the inflationary scenario that the Fed would be looking for. They tried. Like, you think about it, the best jobs numbers in history was at the end of the Obama administration, all the way through the Trump administration, leading into the pandemic. And so here they had the best jobs numbers in history, but yet the Federal Reserve failed to achieve their 2% target that they were looking for. All right. Why can't I find? Sorry, guys. I was just looking to see if I could find a neutral unemployment rate. The natural rate of employment. Here, oh, they discontinued it. Oh, so that doesn't. How far back does it go? February of 2001. So they ended that look. But anyway, the unemployment neutral rate was incredibly low. Let's see, back in 2000, it was somewhere around 4.5%. Or 2020, I'm sorry. 2020, it was around 4.5%. So, and it's fallen dramatically. So, like, what they have discovered is that they can pretty much have as many people working as they want. Like, you can have as many people working as you want. It doesn't create the inflationary scenario that they would be looking for. Because they proved it back in the great financial crisis that, like, or post after that, the end of the Obama administration leading all the way through the Trump administration, historically low unemployment didn't create the inflationary pressures that they were looking for. So now the Federal Reserve can run full employment constantly. All right? They're not worried about the employment part of things creating the inflationary scenario. And I think that's really important to understand as far as like how it is that the Fed would try and find inflation. Like, again, like trying to get the jobs up and get more people working to try and spend that money into the economy wasn't going to create an inflationary pressure. And so again, like, they don't have to worry about layoffs either. They can run full employment the entire time, nonstop, from like now on. For some who carries hard copies of the Fed minutes, interesting that you are streaming during the FOMC speech. It's because I can't listen to the whole thing, and I want to be able to listen to the whole thing. I only have a few more minutes here, and I got to go back to work. So yeah, while they're giving the speech, I'm going to do this video, and then I'm going to go back and I'm going to review it with, focus and intent. All right. Expect an emergency, then a near zero interest rate, then hyperinflation that fails, and IMF installs central bank digital currencies. Lag between 12 to 18 months, mass layoffs coming, already planned and in progress. Well, I do agree with the lag period, in that in about a year we'll see the full effects of the interest rate adjustments. But I also have to think that we have had 5.5% on the Fed, well, 5.33, whatever it is, on the Fed funds effective funds rate for a year. So, like, we are feeling the full effects, or coming into the full effects of that heightened interest rate in the economy right now. And although we see very much a recessionary pressure, and it probably is going to continue to build if it was to remain elevated. I mean, I don't know if you can have necessarily, I don't know how am I going to try to explain this, just because the rates are coming down, if that's going to be the recession indicator, or if the market perception of the Fed funds rate dropping so significantly is indicating to them that there is bad times coming, and then they start acting accordingly to it. Like, to be honest with you, a half a percentage point seems quite significant to what it is that the Federal Reserve is really, in my mind, attempting to do, and that is use their forward guidance to really guide the market. I mean, it wasn't like people weren't aware that there was going to be rate cuts coming. It wasn't like they didn't start acting accordingly. They have definitely pushed the forward guidance into the markets, into the people's perception. It, but as far as like preventing or causing the recession, I think that's really where I think it's going to be very missed by the markets themselves, as they feel that there's probably going to be recessionary pressures coming, and that's why the Federal Reserve is dropping rates. I look at it a little differently. I look at the Federal Reserve and their dual mandate, right? Full employment and low inflation with stable prices. And so if the full employment is still taking place, I don't know if that's necessarily going to be recessionary. Like, what's the worst part of a recession? Everybody loses their job and they bail out the corporations. But as far as bailing out the corporations go, if the viable companies, the non-zombies, are sitting on a lot of cash, which they are, then they don't really have any real like reason to bail out these corporations. If unemployment stays low, then they don't need to bail out corporations. So again, like, I think the bailing out of the corporation has already taken place. I think this is going to be a recessionless recession. Like, we could have recessionary pressures coming, but unless everybody, like, unemployment rises significantly and the bailouts start to happen, if neither of those things happen, then really, like, how bad could it possibly be for the average person out there? It wouldn't, right? They would ultimately maybe lose their good job and have to go take a crappy job, but there's a job, and that would be, what essentially the Federal Reserve would be considering employed. Whether you had a good job or a bad job, it doesn't matter. You're employed. All right. Let's see here. All-nighter, great to see you here. I hope everyone is well humped on this hump day. Powell is pathetic and waiting for reports. All right, Paul, I appreciate your analysis, but you assume that the criminals aren't in charge. Well, what part? Like, I mean, of course they're in charge. Like, in charge of what? The financial system? In charge of debt issuance? In charge of, the Treasury Department? In charge of what? Like, I mean, they're in charge of all kinds of stuff out there, but they're in charge of me? Are they in charge of the decisions that I make? Are they in charge of, like, the business plans, the ideas, the investments, the money that I spend, the debts that I take out? Are they in charge of any of that stuff? No, those are all based off of my decisions, my understandings, and what it is that I'm going to do. Like, I have my own economy. They're not in charge of me. They're not in charge of my decisions. So they're not in charge. Like, they're in charge of some things. They're in charge of things that I have to look at to say, okay, now that I understand what it is that they have going on out here, I have to act accordingly to that. But they're not in charge of me. They're not in charge of where I put my money. They're not in charge of, like, the amount of silver or Bitcoin I buy. They're not in charge of how many debts I take out. They're not in charge of the businesses I want to start. They're not in charge of the businesses that I want to invest in. They're not in charge of any of that stuff. Now, we can say the criminals are in charge and then talk about all the ways that they prevent us from acquiring the things in our life that we really want. Okay, well, that's an external blame, and I don't blame the external. It's just like, if I can't do it that way, I'll figure it out another way, because I'm not being held down. Right? I felt I was already held down when I was in my early 40s. I was drinking, I wasn't paying attention to what I was doing, I was deeply in debt, I had all these issues going on. That's when I was being held down. That's when I thought the external was the problem. Once I figured out that it wasn't that, it was me and the way that I was reacting to all this information and, issues that were taking place out there, it was all about the meaning that I was giving it and the way that I reacted to that information. That was it. They're not in charge of me. That whole idea, you'll own nothing and be happy, it was just like, man, I already own nothing. That's not a threat. That's not a threat to me. I'm like, you'll own nothing. I'll be like, whatever, I already own nothing. Yeah, that's not a threat to me, Yes, it was my fourth child is on the way. God is good. Right on, Kirk. Great to hear. Never give up. You just got to know they will get what they want. Never assign incompetence to what only be described as intentional. The game has rules. Was it 25 or 50? It was 50 basis points. Yeah, they cut a half a percentage point. That's huge. Like, the market is going to, I don't say the market. Like, I think the people in general are going to then, they're going to be happy in the sense that they will be able to borrow money cheaper. But I don't think that's going to be easy money policy. I don't think that's going to create a situation in which that people are going to feel better about the economy. I think it's still going to be quite restrictive. And I think as the neutral interest rate falls, I think the amount of restriction within the economy will probably be maintained. Like, even dropping 50 basis points probably just maintains their restrictive position in accordance to the neutral rate. Like, it's as if they didn't do anything, right? Because the neutral rate is falling, the Fed funds rate has to fall along with it just to remain at the constant restriction that they were at. So again, I follow that. You're not going to see a lot of people talking about that. In fact, they're going to be, blasting off on all kinds of other things, which, a lot of that's accurate and factual and, probably relevant. But if you don't incorporate the neutral interest rate, then you're not going to understand that the economy is still in a restrictive position and is going to be going into the future, considering the neutral rate is falling. Yeah? It's important to internalize, All right, I'm getting close to the end here, guys. Just because you have money and you think you're doing what you love, that doesn't mean they're not in control. Enjoy your little pleasures, but you cannot live out of their system. M Writer 777. The problem with that exact comment right there is that what you are wanting me to do is then take my internal issues that I have and you want me to blame it on the external, right? So now I have a reason why my life is shit, why it is that, it's not easy, why it is that I'm not going to be happy, and why I'm not going to own anything or whatever. Like, you're asking me to take what it is that I have removed from my life and internalize and say, okay, I need to deal with this myself. And what you are wanting me to do is remove that from the internal and then start blaming the external again. I'm not going to do it. I'm not. Like, you can go ahead and say it all day long, all the issues that they are doing to restrict me and prevent me from success and all that other stuff. I don't see it that way. I simply do not see it that way. If they are restricting me, I have to internalize that to understand what it is that I need to do in order to position myself accordingly. I do not blame the external anymore. All right. Now, maybe if I had a whole crap load of businesses and investments and all kinds of stuff, and it was getting damaged because I didn't understand what was taking place, and I was watching my businesses fail and watching my portfolio fall apart and all this other stuff, well then, yeah, maybe I might blame the external because I don't know what's happening out there. Right? But because I understand it and I have internalized this information to the point that I'm saying I'm not going to blame anybody out there anymore, I'm going to position myself accordingly regardless. Go ahead and do what you got to do. I'm going to act accordingly to it. And whether I'm successful at it or not, I guess it's on how I understand the information. All right, I think I got to go. Yeah, guys, I got like 5 more minutes here. All right, the economy is shit, man. Your buying power is 10 times less than it was 20 years ago. Lego Miego, great name, man. 20 years ago, we were using a fiat currency system. Today, we still use a fiat currency system. Now, something I found interesting about fiat currency is that it's exactly that, currency. It's not hard money, it's currency, meaning that it's meant to take my goods and services and production and abilities and transfer it over into other goods and services and abilities and skills that are out there. Now, it doesn't have anything to do with securing wealth. It has everything to do with transferring the ability to trade goods and services and skills and items. That's it. It's meant to trade, to do this current, right? It's currency. Now, to wish and hope and dream that it retains its purchasing power, you have to transfer it over into silver. You have to transfer it over into Bitcoin. You have to transfer it over into stocks. You have to transfer it over into bonds. You have to transfer it into something else that is not fiat currency, because fiat currency doesn't hold value. It's not designed to. We want it to. We want it to be backed by silver so that it has its purchasing power retained, but that's not the condition we're in. So we can blame the external again, saying, hey, it's losing 10 times of its purchasing power over the last 20 years. Yeah, I know. And it's going to continue to do that going